When you started 10 years ago, what were your kind of investing guardrails when you think about those options?
We decided at an early point that we didn't want to build two large teams because we really didn't know how expansive the system would become. So we decided to go in with consumer as a theme.
How do you think about the wealth allocation itself across the various asset classes that are available?
For our house, we do not really mark up the valuations. We actually show the valuations only when they are realized in the account.
I don't think no conversation nowadays is happening without AI, isn't it?
It's almost like a science. We don't really get married to things we have bought. There is just endless possibilities on what we could achieve by using AI in financial services.
We're playing the game in a flat world, right? So there is always question of why is OpenAI not coming from India?
Startup fund of fund was what, 10,000 crores, which is nothing in today's day and age. Just like corporate India was forced to do CSR, why don't we have that in corporate India for some percent of the early ecosystem?
Hi, this is Shubhanga, and I will be your host through these conversations with real thought leaders, operators, and people investing in financial services and the world of fintech. This podcast is not about headlines or hype. It's about first principles thinking, how capital moves, how products get built, and how real operators make decisions. Today, we have with us Benaifer, who is the CIO at Raay Global Investments, the family office of Mr. Amit Patni. Awesome. Benaifer, thank you so much for doing this. And you've been in the allocator world for now over 10 years. So one of the first questions that kind of come to me, especially as an observer, and now more so as an investor as well, is increasingly the gap between people who are in the world of allocation and people who are actually kind of building. It feels like that distance is shrinking. How do you kind of feel about it, and how has the ecosystem matured from your vantage point in the last, I would say, 10 years, which is where the first, decade of India's digital revolution in some sense?
So let me just start by saying that I've been very fortunate because this journey of mine started with the family office side about 14 years ago. And at that particular point in time, we had a different administration in the government. And what happened after the current government came into being in 2014, was that we saw a lot of Indians who had gone to the US or to Europe study-wise, work-wise. Most of them started flowing in, getting their experience to Indian shores, and started to nudge a bit on the early stage ecosystem. This was, I remember, 2013-14. And what happened in that time was that we were fortunate because as a family office setup, being one of the very early encashers of, the listed company, and having the promoters available in their time so that we could, kind of use their time to explore more options on the early stage side. So I thought that why don't we use his experience of an end-to-end, company entry, exit running to, mentor some of the younger age guys. That was when we were actually looking out for them. In the sense of we were trying to see who are the new kids who are trying to do something different, who can we invest in. It was more, like we had to draw them into our ecosystem, because the first thing would be, why do you want to put money? So I've had actually some conversations where I had to have 3 meetings to convince that person to take money from us.
Okay, interesting.
So yes, that's true. And that now has completely, toppled over its head, because the amount of deal flow that we get on a daily basis is just so humongous that now most of the time our job is saying no So that's the difference now which has happened. Also, I think the fact that most founders have understood the value that families can bring. So a lot of them are actually reaching out. Let's say if they were in a particular domain of business which was coherent to the nature of the family where they made their wealth, then they tend to kind of come and plug in into the same system to explore the networks.
And tell me something, when you started 10 years ago, it's very interesting that you say that you had to pretty much convince them to take money, but you obviously also had some of the early funds which were fairly kind of investing into the first set of digital companies that were coming out. So how were you thinking about, using the expertise slash experience that a fund manager brings versus helping founders directly? What were your kind of guardrails, investing guardrails, when you think about those options?
So, if I can name a few funds which existed during that early part, if I remember correctly, there was Chirate, there was DSG,
Probably Bloom had just started.
Bloom was there. I think just about these two, three that I can think of. We of course met all of them, but the ecosystem was too too young in India. Also, I think the AI framework, the alternate asset framework, had not been put into place. So there was a lot of VC culture, right? In fact, we also ran our own fund called Nirvana Venture Fund, which was championed by another specialist in the domain for the family, where we also raised external capital. But also, I think at that time we were learning from our own experiences, and we were also trying to evaluate, the men from the boys. So that in that phase, we thought it was better that we shape something in house, and we did individual companies in house. Post 2015-16, when the alternate investment framework actually came by, and a lot more structure came into the funds, that's when we started exploring the alternate funds on the venture side.
And what were the kind of guardrails for you to say, you know what, actually, this is the company that you would want to invest in versus, this is the fund that you would want to invest in?
So the companies were pretty easy because what we had done is we had specified that we would do what we understood best.
Okay.
So
Could you elaborate a little more about?
Sure.
What were they?
We decided at an early point that we didn't want to build too large teams because we really didn't know how expansive the system would become. So we decided to go in with consumer as a theme. So we would see consumer linked companies.
Okay.
So that was easy. Post a few years of experience in consumer companies, we extended our reach to finance and fintech companies because, again, that's a domain that I understand very clearly. And the last thing that we did in 2018 was we expanded it to media and content. So these were our three things that we were very clear. We left everything outside of this, is not within the domain of our investments.
Yeah.
On the fund side, so we had some experiences on consumer. If you notice, the funds that I spoke about also started with a lot of consumer investee companies. If you saw their fund one, etc.
Sure.
And then matured out to
Yeah.
all the other phases. I think so. We were trying to kind of learn from our experiences on the by being on the board of those those early stage companies. At the same time, we were exploring what are the new age things that the fund managers are doing, where we don't essentially want to build our expertise, but we want to draw on that part of the asset allocation.
And so one of the things that I've observed, especially kind of having lived in the West now for the last 7 years, is in the Western markets, I think there is an increasing, understanding that there is a kind of a job that the fund ecosystem does. And so while they do kind of invest into companies, they don't get into the early stage side of the equation. But in the Indian ecosystem, however, I have kind of seen there are quite a few family offices which also get fairly early into the the startup's life cycle in some sense. And it is being kind of turned more as the patient capital for the ecosystem. How do you kind of see this duality between what has kind of been the trajectory in the West, and are we trying to kind of do too many things too soon in the Indian ecosystem? How do you view that?
See, the Western markets are definitely far more developed, right? So I think I don't know, other than a few families, I think in the Western world, like Rockefellers, etc., who actually had exposure to a lot of companies, maybe, even Warren Buffett and his likes. A lot of that initial capital used to come from pension funds and endowments to some of these venture capital funds, right? Because that was the patient allocator. In India, unfortunately, we don't have that system as evolved. The pension or the provident fund system
Correct.
is still very nascent. And as a result of that, there was one need for somebody to bridge that gap. And considering that families had made some wealth historically passed on across generations or first time companies or whichever way they made it, they were the first ones to identify that there was a need to nurture nurture the early stage companies, as a result of which these actually got funded by the families. I think.
And so, if I kind of now go a little more deeper into how you think about investments in general, of course, I mean private markets is one part of your overall asset or wealth allocation. So what I would want to kind of talk a little more is how are you thinking about, or how do you think about the wealth allocation itself across the various asset classes that are available, and where do public markets versus private markets kind of sit, and what are the other asset classes that you think about?
Sure. So yes, I do have a very vast job role, which is a fact. So we started by not really defining the percentage of what we would want to hold in private markets when we initially started. As we matured the last 12, 14 years, we have decided a cap on what we want to have in private markets versus what we want to have in public liquid markets across. So that number ranges in the range of about 5 to 7%.
5 to 7% is private markets
Of the overall allocation. I'm talking about it at cost.
Sure.
Not as, we don't consider it as MTM.
Yeah, for sure.
So for our house, we do not really mark up the valuations. We actually show off the valuations only when they're realized in the account.
Okay.
So I'm talking about more from a cost allocation perspective. So about 7 to 8% max on privates. We go in the alternates, which this is a subset of. We go up to about 15%. And then we have a mix of, let's say, public markets as in equity, debt, which has a subset of mutual funds, credit funds, venture funds.
What do you mean by venture funds in public markets?
Sorry, venture debt funds is more correct. Yeah.
Okay.
So we have a
essentially,
mix of them.
what will give you liquidity
Correct.
As soon as
Correct.
as required, and
Correct.
so that forms what percent?
Also a payoff, not only liquidity, but
appreciate.
also a constant stream of income.
Fair. And so what would that percentage kind of look like for you, the public market side of the equation?
So on the venture debt side, you mean?
No. In general, what's not private is what I'm trying to say.
So roughly about 85% of it.
So it's bulk of it is there.
Yes.
And
Yes.
And within that, do you also kind of include commodities, or you don't touch commodities?
We
at all?
do.
Okay.
We do. But that forms a part of the 15%.
In the alternates.
Yes.
Understood. Now tell me something. I mean, in the sense like, especially in the last few, I think post the 2024, where elections happened across the major economies, the markets have been volatile, and I think public markets have also been fairly subdued. How do you kind of go about thinking how to change your asset allocation strategy, especially in these changing dynamics? And should this also reflect in some of our personal portfolios, the thinking that actually comes from a family office institution like yourselves? Should this also reflect in, or would it reflect in your personal portfolio, for example?
So the answer to this is no. It doesn't reflect in my personal portfolio. But I'll tell you the way you approach a family office, and I'll tell you why it doesn't reflect in the personal portfolio. For an institution and for a setup like ours, consistency of capital, let's say wealth appreciation and wealth preservation are equally important. So when we make an allocation matrix for the family, we will divide it into sub-accounts of whose wealth am I managing within the family? So let me just give you an example. If it is the patriarch, he's of a certain age, he has certain explicit requirements of the wealth in certain domains, versus a grandchild who is really not in a position to draw any out of the wealth. So the portfolio mix for the grandchild versus the patriarch are fairly different. But as a holistic part, we still stay on an asset allocation. So we will make the mix for all the sub portfolios and determine a blend. So let me give you an example. If my patriarch has two daughters, so one is married, one is still to get married. So again, the mix for what we keep for them is different, though they are of a similar age bracket.
Sure.
So what we need to determine at all points in time is, and when we sit down and do our calculations every financial year beginning, so in the first 2 years, of course, there was a lot of alignment to what we wanted to bring it towards. But once that is done, the portfolio percentage just changes by 5 to 10% on an overall matrix. It doesn't go this way or that way every year.
Hear you. So if I have to kind of ask you a question, what scares you most? Is it more about volatility or is it more, in some sense, suddenly some of these investments actually going down? So you spoke about growth versus preservation, right? But obviously growth has the other side of the coin, which is the risk and the volatility that it comes. So how do you balance between those two? I mean, it's easy to say, but I don't know how you actually do it every.
So what we follow here at Raay is a very disciplined approach of investing and a disciplined approach of profit booking. So both put together, we do not really, let's say, it's almost like a science. We don't really get married to things we have bought. And on the other side, we don't cut it off just because it's making. So both ways, you try and stay balanced. Also, what you try and do is make it more comprehensive. So the first thing when I took over this role, we had decided that we will do things only which give my patriarch good sleep and me good sleep in the night. Anything else which is a little if, we will leave it. And that's the principle we've been going back with time and again. Of course, you will have your losses and you'll have those drawdown days and everything like that. The other thing was also, I made it a rule not to do anything which was giving the family discomfort in the decision making. So in a process sense, the way we followed it is we would always involve them at the final leg. When we are about to allocate to a new fund manager, I would insist that one of the family members would actually meet that fund manager, take a lens, or if there's anything that irks them, I would have noted it and then consider it in decision making. So
I'm going to now come back to your 7-8% to 15% number that you spoke about in the private markets and the alternates, right? How big is that portfolio for you? And one of the things that, I grew up more from the angel investment side of the equation, right? So there are about 49 companies that me and my partner have invested in to date prior to Agama. And question that kind of keeps coming to us is how do we even kind of manage such a huge portfolio? And if I'm actually investing more at the angel stage, I'm sure, there are quite a sizable number of investments that you would have done. So what would you want to kind of give us a little more light about how big the portfolio is, both funds and direct investments, and how do you actually kind of manage?
So I'm not able to share the numbers because it's privy to the family, and I'm the confidant of the family. So I can only talk about the overarching perspective. However, I can only tell you is that we don't spread ourselves too thin.
Okay.
So in these 14 years, we would have done not more than, I think on the venture side, on the equity side, we wouldn't have done more than 5 funds.
Okay.
On the credit side, we would have done not more than 5 funds.
Got it.
On the venture debt side, we would have done not more than 2 funds.
Very interesting.
So what we believe in is that you select the correct manager and then you put the money behind them.
Yeah.
Instead of spreading too thin.
Yeah.
So we would never do a 49 fund portfolio.
Hear you.
We would always.
I have heard those numbers from some of our other conversations that we are having, especially as we're talking about Agama,
Okay.
right? So I've heard huge numbers.
Yes. I know some families are actually doing a spray and pray approach.
Correct. And so that's interesting. And so consequently, the next question to you is, do you, especially when in your direct investments, at what stage do you typically like to go in? And do you continue to do direct investments? So all of those are questions which kind of will make sense only if you continue to do.
We are, so we've not done, I mean, we've done about 13 or 12 investments in the entire range.
So that's not.
Again, so we are more opportunistic.
Got it.
We do not really chase being part of a sector or a segment.
Got it.
If we find the right mix, where we feel the urge to participate, because if I feel that I have a very lovely term. So in the beginning of my career, there was a lot of families who would come to me, because we were very few of the families who were set up as a like a structured family office.
Yeah.
So I would get a lot of, are you doing this deal? Are you doing that deal?
Yeah.
Can we participate? So there was a lot of FOMO, right? Actually, now there's somebody else came across a few days ago and gave me another term. So I said, what is this? So he said, I have a lot of JOMO. I said, what is that? So he said, it's the joy of missing out. So I said, that's brilliant, because then you're choosing wisely.
Yeah.
So I think that is where we are. We are selective. But we are alert about what are the newer things.
Sure.
The approach might have changed. For example, see, fintech, for example, is a very vast space.
Correct.
You could do sub-segments of fintech.
Yeah.
But it is not where it was in 2016-17.
Absolutely.
Okay?
Correct.
Because the payment space is evolving, the liability side is evolving, the asset side is evolving, the system side, enterprise side is evolving.
Totally.
So how do you participate in the growth? So that's where you choose a fund, for example, when you want the flavor, but you're not the in-house expert for all these subsegments.
Makes sense.
But when you're probably doing agentic AI, for example, and if you're like, we've got one company in the HR side of things, where we are very bullish on what they've set up as a system. So we would then take a call based on where they are in their life cycle also.
Anything that has really interested you in the... Because I don't think no conversation nowadays is happening without AI, isn't it?
Everything is AI.
So
Everything.
So two questions to you. One, any company that you're tracking that is really kind of attracting your attention, number one. Number two, are you using AI in your everyday, and how are you guys internally using it?
We are starting to adopt it. I wouldn't claim that we are the masters of it.
Sure.
But we are starting to use it for equity analysis, etc.
Sure.
But few and far between, because you see, once some result throws up, you have to again go deeper dive and find the genesis of why that result has been thrown up.
Sure.
So whilst we have human intervention, we still use it to just, let's say, get the mundane jobs done a little quicker. But we are still progressing. I wouldn't say we are evolved. Sorry, what was the second part you asked?
In terms of, are there any companies, especially in the AI infrastructure kind of spaces?
No, I don't have anything.
You're not tracking any of those?
No.
Especially in the global market side of the equation?
No.
No? Okay.
We are not really exposed on the global side on private deals much.
And so when I mean, you have been a practitioner in the financial services space. So when you kind of look at what is the future of fintech, and what do you envision, and how do you think about opportunities that will come in the near future, especially with what's happening in the AI equation? What is your hypothesis for this space?
See, one thing for sure is that decision making is going to be enabled by a lot of tech much quicker than what it was, let's say, in the previous days, when you would have to go through newspaper articles or surf the web or try and do your own comparisons on various websites to see what you've got and what you haven't. So the synopsis nowadays is much easier, but I would still think that an oversight of human intelligence is required. because whilst data might do its own analysis, the practical world knowledge still has to apply to decision making. So I think that will continue. What sides of fintech will grow? I think there is just endless possibilities on what we could achieve by using AI in financial services, whether it's banking, whether it's asset management, whether it's loans. The other day, I met one other company which is more into giving a liability profile for each individual at the tip of a app.
Yeah.
And they could actually tell me that, okay, you have this credit score, and with this credit score I can see that you've taken X loan from so and so and Y loan from so and so, and if you replace this X loan with the Z loan from so and so, then you would be saving 20 lakhs per annum, for example.
Sure.
And it was in granular detail. And it said that if I invested that 20 lakhs for the next 20 years, what would be the compounding of that capital, right? So it gets you to start thinking whether you're doing things more optimally.
Do you think in the market, we have kind of also moved as an ecosystem from this growth at all costs to something that is more governance led, and people are valuing the quality of growth rather than just growth itself?
So I think, again, I would blame the West for this.
Okay.
Because they got capital which was fairly consistent, long dated 15-year, 10-year endowment money. So they led the companies towards believing that growth is a prerogative and profits are not. COVID actually gave a lot of realization to even those allocators. And I'm sure in the US, I've at least seen a lot of them are questioning the valuations, the exits, etc., etc. But so that, I think, came from the West. When you see it in the context of the Indian ecosystem, I think Indians always believe in profits. अगर धंधा किया तो पैसे के लिए किया, वरना क्यों किया? That's generally the essence. So a lot of rethinking in a lot of our portfolio companies, in a lot of our venture capital companies, the fund companies. I think even the VCs now are directing them more towards break even and profitability versus earlier.
Sure.
When it wasn't the case.
And I think one of the things that I keep thinking about is, at the end of the day, we're playing the game in a flat world, right? So there is always question of why is OpenAI not coming from India?
Yeah.
Or why is the next Google not being built in India? Of course, I mean, I think it's heartening to see what Sarvam is trying to do, or what Gyani is trying to do in the country. But in a sense, I think if we are actually trying to build global companies from India, and if the global companies are actually playing the growth game, how do you, or how would you kind of look at some of the new age founders who are starting product companies to build for the world should be thinking about this? Are we actually then missing out?
The growth versus profit thing?
Yeah.
So it depends on the sector. For example, one company we have in our portfolio called Neural Garage. They are essentially a visual dubbing platform. IP is very, very, very close to them. Just for simplicity, I'll tell you what they do. They have been able to, they've been able to prove this technology in 4K resolution, which means that, if any of you have seen this movie War, War was shot in Hindi.
Okay.
Normally it's dubbed over, voiceover.
Yeah.
But this technology can actually change the visual effects. So Hrithik Roshan is speaking in Telugu, and his words are moving in Telugu, his sound is moving in Telugu. His voice is fully dubbed over in Telugu. So with the help of AI. So I'm saying that these companies are actually a moat in themselves. Now, if you try to say that profit first versus growth, it's not going to happen, because this company needs to have the growth in the range of what they can do, and also in the tech first approach. So I think it's very specific to the companies that you are dealing with. It cannot be a one brush paints all kind of scenario. But you have to see it in the light of what each company is delivering.
Yeah.
So I think that's where the difference lies.
And so one of the thesis that we have is growth, in a sense, can come profitably if it is actually ecosystem and community driven. And of course, my partners Abhishant and Pankaj have done a lot of work in the last eight years in the fintech ecosystem. But equally, I think from your point of view, and people who are in your kind of vantage point as allocators, how do you kind of look at ecosystem clusters of what do you call, whether it is financial services as a space, healthcare as a space? Are they going to be more verticalized solutions that are going to actually kind of see more growth, or is India actually in a position to do horizontal technology, which is not necessarily what do you call, India only kind of stories? Are we actually at a tipping point where we are going to start seeing horizontals, which is...
So I'm not an expert on this side, but I can only tell you what I see is that there is just so much for us to solve in India first, that I think entrepreneurs who at least I meet are looking to solve India first.
Sure.
And then probably see the adaptation of it offshore. Let me give you an example. We are investors in Policy Bazaar.
Sure.
Yashish and Alok started very basic. They tried to explore. They were from the West. They came here, figured a gap, sought something. Now, as they're a mature company, they are actually taking the solutions to the Middle East. So I think it's an evolution process. It need not be offshore first or offshore along. I think it has to be India first for the companies here. And just like we did UPI, we finessed UPI here. Now we are giving it to other countries. And happily so, we time tested everything possible. So I think it's a more robust way of doing things instead of building for a global scale, because every geography is very different.
But I kind of tend to disagree here, simply because if you look at the mindset with which the American ecosystem or even the Israeli ecosystem has built, one of the things is actually they look at planet as the scale, right?
Yeah.
And I kind of personally also go through this duality in my own mind, in terms of, like, obviously we've seen founders building for India, but is this probably one of the reasons why we are actually not seeing global scale? I think we have seen a few, right? Like, of course, I mean, you can think of Postman as an example from India that has come out, which is actually global scale. Polygon was another in the crypto ecosystem prior to the COVID scenario. But there are very far and few which are actually kind of building at a planet scale. So how should actually what is your advice to founders? Because if people come and ask me, I actually kind of say, think global, and India comes under global as well. Of course, India could be your sandbox for all practical purposes. But I keep thinking probably this advice might be one of the things that we need to start changing as an ecosystem.
I agree with you, but I also have one question for you in return for that. When you're trying to build something global, you have to have the advantage of capital by your side. Then you can have, an expanse which you can monitor, you can learn from, you can make mistakes, you can mend. So first, I think as we speak of Indian companies going on a global scale, we as an ecosystem, as family offices, as HNIs, etc., have to ensure that we have enough capital available to our companies to explore that base.
Sure.
And what I see still in Indian context is, let's talk about last financial year, for example. I think the amount of OFS that the promoters did in the public markets was one of the most expansive ones I've seen in my career. Where is that money going? I don't want to be, like the kid in the block who calls it out, but it's going into real estate or into jewelry. So is that a productive use of capital?
Sure.
right? First of all. And secondly is, if you ask any of the promoters who we have across 14 companies, they will ask me the first thing, how much runway do I have from the capital that you're going to provide me, right? So I think whilst your argument of building on a global context is correct, but if you are able to say that I'm SoftBank and I'm sitting behind you and you can experiment and build for the globe, perfect. But how many such investors do we have in India?
So what would be the structural structural kind of improvements, changes that we need to bring in as the ecosystem
It's
here?
very simple. We have employee provident fund money.
Yeah.
None of that is allocated to the early stage ecosystem. We have pension money. None of it is allocated to the early stage ecosystem. Now government has started doing SRI and RDI and those which are like
Yeah.
1 lakh whatever, right? But that's still, I mean, startup fund of fund was what, 10,000 crores, which is nothing in today's day and age.
Absolutely.
Right? So I'm just saying is that why, just like corporate India was forced to do, what was that, CSI? What did they call
CSR.
it? CSR?
Yeah.
Right? As some percent of the profits.
Yeah.
Why don't we have that in corporate India for some percent of the early ecosystem, or in backward or forward integration of their own supply chains? So I think that's what's missing.
So, and would you say given, and I'm now kind of taking it back to where we started, right? When we said family office, especially allocations, are coming so much closer to the founders ecosystem. So if, let's say, there is actually an institutional ecosystem that is going to get built in India, not for today but for the next decade or two, will, apart from the pension funds and the corporate India, will family offices also participate in this institution building, or do you actually see family offices continuing to work directly in the founder ecosystem, and this will be more like an adjacent ecosystem to the family office ecosystem? How do you kind of view the structural shifts?
See, I think the structural shift can happen more from the corporate perspective, because families go through their own transitions. Today there is one patriarch, tomorrow there'll be another patriarch to the same wealth,
Sure.
which is being carried forward. The aspirations of the patriarch versus the next generation versus the third generation are always different. We hear it all the time from our parents. We never saw this, we never did this, we never took so many loans, we didn't do this, all those kinds of things. And that's bound to evolve. Today, the amount of venture funds which are set up by families are so many versus what I used to see 14 years ago, right? So I think that also will evolve in the next phase of, maybe it'll go to a crypto, or maybe it'll go to some other asset class, or maybe it'll go to tokens. I don't know what is the new evolving thing, but that's inevitable, right? So I don't think that, because the structure of each family is so unique, it is not possible to have a glide path towards long allocations of capital
Yeah.
from that. But from corporate treasuries, it becomes a very easy kill, if I can call it. From insurance companies, it's an easy kill. From pension money, it's an easy kill. And we have a large pool there as well.
Amazing. Thank you so much for your time, and hopefully this is going to be the first of many.
Thank you so much for having me. It was a pleasure.